What's going on, guys? So today I want to talk about protecting large portfolios with options. We're specifically going to talk about 3 different option strategies that can protect your portfolio in a downturn. Each of these 3 strategies we're going to discuss in detail and how to open and close each position, as well as how to manage this position when you open it in between from closing it. As you will see right here, I've opened up Tesla stock. So Tesla has fallen a lot. I mean, this stock in the past 3 months was trading for much higher levels. In fact, it peaked around $1,100 in the past 3 months. Now, Tesla has been in bear territory as well as the rest of the market. The market is super dangerous because it will continue to fall, but shows signs of recovery. So just buying put options can be very, very tricky. So instead, there's a few different strategies that I'm going to recommend. The first strategy is a call credit spread. So with buying a put option, you need the stock to fall down. You need it to fall down quickly, right? If it falls down, your put option starts making money. So that is a situation where you need something to happen. With a call credit spread, when you sell it, you collect income and you're hoping something doesn't happen. So you see how the second thing is easier than the first thing? The first thing is you need something to happen. The second thing is you need something not to happen. So it's much easier to bet on something not happening than for it to exactly happen in a specific time. So the way you're going to open up a call credit spread, and also I'm going to explain you the reasons, because number 1, you collect premium. Number 2, this position hedges your portfolio. Number 3 is going to bet on a price that you do not think the stock will hit. For example, say Tesla's currently at 775, right? Well, you see there was a short-term spike here on May 4th up to $952. This is where Tesla spiked, but it could not maintain the momentum and it could not hold these levels, and it ended up falling further. Now, Tesla is recovering a little bit, so it is dangerous to just buy a put option. However, selling a call option right here at 950 is going to be really safe, especially if you do that in 1 week. Because even here, May 4th, it went down and it went down to May 13th. So this happened really, really fast, okay? VIX is really high right now, meaning volatility is basically at its highest it's ever been. If I open up volatility right now, which is VIX, again, this is a fear index. This is what Wall Street looks at to kind of gauge fear, like how volatile are stocks going to be over the next 30 days. That's really what VIX is measuring, okay? So if I go to 1 month, VIX is basically around its peak, but if I go to 1 year, you're going to see how high VIX is right now. So right here in the past year, VIX was really low because we were in a bull market. So VIX was not really, high. We would have short-term peaks at maybe 20, and then came January, okay? January is where things really started to peak out. Right here, January, 31 VIX. That's very, very high. That's when the sell-off started happening. That's when tech stocks started selling off. I mean, this is where Cathie Wood started losing about 60% of her portfolio, and so many tech stocks are down a lot. Now, VIX was around 36 in early March. This is basically as high as it's ever seen, because when you look at VIX historically, it's around 15 on average. Being at 30, this is already double. So currently, we're sitting still at around a double VIX. It did pull back a little bit because we had a really bullish market trading session on Friday. However, right now, I don't really see a reason for it to go back down to 15. I think we're going to stay around these elevated levels for some time until the market really gets some more ground. All right, so now I want to show you a call credit spread on Tesla. Because VIX is so high, this is actually a fantastic thing for selling options. And selling call options or selling put options, either way, it's the same, because one of the factors for an option is its vega. Vega has a lot to do with implied volatility. Implied volatility, the higher it is, the more expensive, or the more this option is sensitive to a volatility fluctuation. And because option traders are pricing in volatility, of course, they do not like volatility, but when there is higher volatility, they price that in and they want to be compensated more for taking the risk. So if you're an option buyer, it becomes way more expensive to buy options. Whether that is a call option you're buying or a put option you're buying, either way, it's more expensive. Now, this is a good thing if volatility is high and you believe it's at its peak or near its peak. And again, looking at the VIX, it hasn't really been much higher than 36. Currently, it's sitting at 28, so I would be surprised for it to go back up to, 36. This hasn't really happened too often in history. Now, you can see if I go to 5 years, VIX doesn't really go up beyond 30 all that often. Now, in fact, during the pandemic, it did, but really in the past 5 years, it really hasn't. If I go to the max right here for the VIX, you'll see that, the last time it really went up above like 36. Okay, maybe around here shortly, September 2011, shortly roughly on June 2010. But before that, it was really the 2008, market crash. So since 2008, or really since 2004, VIX has only been higher than 30 a handful of times, and it has not stayed above 30 for a prolonged period. That means that selling covered calls right now, that means that selling call credit spreads is likely to be very profitable. So let me show you what that looks like. I'm going to go to sell call option. Now I want to look for a good strike price. This is pretty much one of the most important things. Now I was telling you guys how I was looking at the chart for Tesla. It had a short-term peak around $950. It was actually $952. So I'm going to scroll up and look at $952, and this is where I will start kind of digging in deeper and seeing, can I make some money at $950? Because I already know at this level it is going to be super safe. So looking at the $950 strike, this is where on the technical chart I saw that Tesla had a lot of resistance. However, now that I'm looking at this, the premium is very small. It's $67. Even if I go up and do a $500 spread, which is basically me picking $950 to sell and $955 to buy, the difference here is only $6. So I'm going to sell 67, buy 61, and keep a difference of $6. Now that is not much money. That's not bad. 6% on $500 is actually 3%. However, I mean, it's just not the biggest return, and it's not that attractive considering that there is still a $500 risk. So I like to go for spreads where I can collect at least around 5 to 10%. 5 is the bare minimum. 10% is very solid. So this is not going to be good because the premium is low. The second thing that's not good is that the chance of profit is 98%. That is super safe. However, this is too safe in my opinion because 98% of the time you're going to be successful, but you're only collecting 3%. So what you want to do instead is start to look for an adjustment, okay? 950 is a little bit too safe. So I'm going to go down, and I'm going to go down, and my sweet spot is around 88%. However, doesn't mean I have to go for 88% each time. I'm actually going to now check out the 900 strike. That's because the 900 strike is going to have a lot of volume. In fact, you can see here it has 19,000. That's because it's a nice round strike. So when people are selling options or buying options, they usually have a nice round number in their head. So I don't know, would you rather $1 or $1.02? You're probably like, well, I'll just take the dollar. I don't want these 2 pennies in my pocket doing nothing. Of course, some people would take the 2 pennies, but you get the point. A lot of people like to have a nice round number. So for 900, this is a very easy strike. Looking at the bid-ask spread, the bid is $1.84 and the ask is $1.87. Very tight, very close. That is very good. The volume is very high. The implied volatility is high. Again, anything over 40 to me is amazing. So over 40 is already beginning in that territory where it has high implied volatility. 73 is very high, and Tesla consistently has around this type of implied volatility. Now the open interest is also very high, but you'll see that the open volume is actually much higher than open interest. Open interest is the total number of contracts that are open in the past. But recently, because a lot of people do trade weekly options, this is proof that people like weekly options, they have opened up a whole lot of volume on Friday. So on Friday, basically it was more than double the total open interest of the entire history for the 900 strike option expiring on May 20th. Okay, the delta here is 0.059. This is, I mean, anything lower than 0.2 is pretty good territory. Anything lower than 0.1 is a little bit too safe in my opinion in most cases. So 0.05 is an extremely safe delta, okay? Now I want to take a look to verify if this is going to be worth selling. So I'm going to sell the 186, then I'm going to buy the 167, and all I'm trying to do right now is look at the total credit. Total credit is $19. You'll see here that I can make $19 and risk $481. Now I know that $20 divided by 500 is about 4%. This is a 4% return, which is better than the 3% return, but again, I think it is still a little bit too safe, so I'm going to go down just a little bit more. But for yourself, let's say that you are not that bearish. Let's say that you're actually somewhere neutral. This would be a fantastic call credit spread to sell, but let's say you want to really hedge your portfolio, you're really afraid, you want to go a little bit closer to the money, then you can go down to like 850. Again, it's a nice round number. I like by 50, 800, 850, 900, 950, 1000, something like that, okay? I can already tell that the return here is very good. It's around the chance of profit that I typically look for, which is 87, 88. I'm going to sell the 628 premium right here. I'm going to protect myself and create a call credit spread by buying the $5.48 premium right here. And my net credit, or the credit is how much I'm actually collecting, is $80. Now you will see that I'm collecting $80 on $420 worth of risk. This is a much more attractive return. In fact, this is around a 20% return. So a much better return. And this option is going to expire on May 20th. And the way you will make money from open to close, as you open this position, your hope is that Tesla stock stays below $850 per share. Now, as long as it ranges between $775 to $850, you're most likely going to see a profit unless the stock really shoots up close to $850 850 very quickly. However, if Tesla just starts rising by a little bit, you're still in the green. You're going to be in the green for the most part, unless you get really close to that 850 mark. Now let's say that on May 17th or May 18th, which is going to be the Monday or the Tuesday, or even May 19th, the day before expiration. Let's say as expiration approaches, the stock is, $805. You're not going to do anything. You're just going to let this option position expire. This call credit spread is going to reap the full reward of $80. Now, if Tesla stock is getting very close to 850, let's say it hits 840. Once it's pushing really close, you need to reevaluate. Do you want to keep this position open, or is it better to close it? What you want to do is you want to look at the technical analysis and look at the RSI. If the RSI is still low and you think that Tesla can keep recovering, then you want to look at closing this position for a potential small profit, a break even, or even a slight loss. Now, this is not going to happen that often, and most of the time it's okay, because when it happens, it's going to happen maybe 1 out of 10 times, 2 out of 10 times. So 8 out of 10 times you're going to be safe. However, if it goes up beyond 840, you want to start thinking about closing your position. It may be at a loss of 10% of the collateral. 10% of the collateral would be about $40. So again, not that bad. You've collected $80 and you may have to close this for about $120. You will have a $40 loss. At that point, you can just close out that position, call this a loss, and call this a hedging loss. Or you can also close out this position and open up a similar position, but instead of 850, 855, it's called a roll. You can go from 850, 855 up to 900 and 905, for example. That will probably give you some additional capital. For example, you may collect $40 or $60 at that point, and when you collect that money, now you haven't even lost any money. So you can keep rolling this position out into the future, and that way you can actually never lose. However, if this shoots up very quickly up to $850, you will have most likely a loss of $100 or $200. At $200, that is about 40 or 50% of the collateral that you put up. Again, 420 is what you're risking. So when you see a negative $200 loss, again, at that point, I would start thinking about closing this position and just moving on to a different position. So that's how you open and close a call credit spread. Now, the other thing I do recommend, if you have a larger portfolio, let's say you're dealing with $50,000 or $60,000, at that point, you can actually afford buying put options. Now, how you want to buy put options really depends on the stock. You want to pick a stock that is pretty expensive, that you do not think can rise further. And specifically, it's good to have a particular reason you think that stock is going to fall. Okay, for Netflix, I'm going to look at Netflix because Netflix has been in very bearish territory for a long time. It is now showing signs of recovery, but let's say that you still think Netflix is a bad stock, okay? And there could be many reasons. Let's say that Disney is going to eat their lunch, and Amazon and Apple, there's all these other streaming services. Sure, Netflix is thinking about how to fix their problems, but I don't think it's going to happen that quickly. So let's say that you want to hedge your general portfolio. You want to do that by picking stocks that are generally not that good. So Netflix could be an example. Another stock that could be really expensive is Cloudflare, okay? You can go to Cloudflare. This is ticker symbol NET. Cloudflare is a very expensive stock. The price of sales is absolutely high, and a lot of price of sales are very high for these growth stocks, especially the Cathie Wood stock. So if you want some ideas, you can actually go to RKK. I just typed that into Google, and when I go to RKK, I go into their website. I'm going to show you why this is important, because this is actually where I will find where to buy put options. And that's because I think Cathie Wood is overhyped. I think a lot of people just follow Cathie Wood blindly. A lot of beginner retail traders are following her, and a lot of traders that are starting off are just buying call options. They're crossing their fingers, they're buying call options, and they're hoping to go to the moon. But oftentimes they're going to end up losing money because, well, they're beginners, and just buying call options just generally doesn't work. I don't know the exact reason why, but it just makes sense because I've talked to so many students. We have over 800 in the Discord, and all of them are just saying the same thing. I bought call options, it's not consistent, I'm losing money. And really, in my opinion, the reason is because you're paying money up front and you're hoping for something to happen. And in the beginning of this video, I said that when you pay and you hope something happens, that's kind of a difficult position to be in. But for a call credit spread, you're actually collecting money and you're hoping something does not happen. That position is much easier to manage. It's much easier to psychologically hold that position, and overall it's just more profitable. But buying put options, there is a place for it. If you have, again, $50,000, $60,000, look for things that are very expensive. So I'm on the website, I'm going to go to their holdings. And again, these are some names that you may want to look into. And you can actually download the full PDF, or you can actually download the CSV file and look through the full list. I think she might have like 30, 40, or 50 positions. But here are some ideas. You can buy put options on Zoom. You can buy put options on Square. Cathie Wood bought Teladoc right before earnings and stock fell down 50%. Look, I'm not perfect. I make mistakes, but I typically don't buy stocks and they fall 50% the next day. So again, it just shows you that there richest people in the world and some of the best hedge fund managers, they don't really know what they're doing. So don't just look at those people and follow them blindly. It's much better to learn technical analysis, fundamental analysis for yourself. That's why I have the Discord community. That's why I have my option coaching academy. And if you want to check that out, it is in the description. But I do believe that you should learn how to fish for yourself. Don't just follow people blindly. And if you look at some of the best investors that seem to be the best, like Kathy Wood, sometimes I would actually bet on doing the opposite and making money from doing the opposite of what they're doing. You know, kind of like Jim Cramer. Anything that Jim Cramer says, just do the opposite and you're likely to make some money there, okay? Now, Teladoc could be a good example. Twilio could be a good example. CRISPR, which I don't like healthcare stocks at all. I think the healthcare genomic space may be a good long-term hold, but in the short term, buying some put options could definitely work. And then Coinbase, we have seen Coinbase come from being pushed by all the big YouTubers, where it was around maybe $300 per share and it's down to like 60 bucks or something. So some of the top YouTubers pushed this stock and I've avoided that. I've been totally against Coinbase for the longest time. I've not really been a bull here and I've never really purchased the shares. I've completely avoided it. And sometimes avoiding something like Coinbase can basically save you like tens of thousands of dollars, because I know that some of the bigger YouTubers have lost like tens and hundreds of thousands of dollars on Coinbase. I have not been a super fan of Bitcoin or like crypto in general, and I've avoided that space, and basically doing that has saved me and my students a lot of money. So anyways, Cloudflare could be a good example. Let me show you what buying a put option could look like. So Cloudflare was trading for $89. It's recovering, but this is something that is potentially called a dead cat bounce. If you watched Billions or just heard of dead cat bounce somewhere, a dead cat bounce is basically when the stock market is a bearish market. It's spiraling downwards. The momentum is to the downside. Over the past 3 months, returns are negative. However, in the short term, you will see little spikes of buying. And basically that happens because some investors think that it's the bottom, okay? But that's what we call a dead cat bounce. The stock market could pull up a lot short term, but then it'll continue being in its bearish territory. So that is likely what may be happening right now. Again, I don't know because I can't predict the future. I don't think anyone can do that. And if anyone says they can predict the future, they are just absolutely lying to you, okay? So I'm gonna go buy put option. Now I'm going to look at buying an at the money put option. What I mean by at the money is currently the stock is sitting at $66. I'm going to basically buy a put option that is right here at $66. This put option costs $3.65 or $365. Now my break even price will be right here because I'm paying money to buy this option. Again, it's a little bit more difficult. You start off right here in the red because you're paying money, and now you need the stock to go down to a break even of $62.35. However, below this point, you start making really good money. You start making dollar for dollar what the stock is going down. So this is a very good position because sometimes in bearish markets, you can see these stocks, rise by 17%, but then it can also fall by 17%, which is essentially going to be a $12 fall. So if the stock falls $12 in, from now until May 20, which is completely possible again, because volatility is super high, market is very uncertain. So if it ends up falling by $12, then your $365 can turn into $12, which is basically a 3 to 4x return in a very short amount of time. Again, don't open up a huge position here, but what I would typically do if I'm buying a put option is I would buy it, hold it until, Thursday or Friday near its expiration, and then hopefully if the stock did end up falling, then I will close out that position for a 3 to 4 times gain. If you want to see exactly what I'm doing, all my plays, get live coaching sessions on Monday and Wednesday, do make sure to check out that description link for that Discord community where I handpick stocks and options on what I'm doing so you can follow along and do the same thing. Thanks for watching.